Morning, everybody. Here you can see me wrapped up for a chilly start to the week here in Melbourne. But I just wanted to take an opportunity to share some research with you. It's not something that I do terribly often, but I think that where we are in this this correction from the coronavirus and from the virus itself and economic activity, it's a good opportunity for me to run through a research report that we receive. We get this research report each month from a research organisation called Zenith Partners. Now, these research reports are generally speaking quite detailed. So rather than me just dump the report on you, I am going to send the report as a part of this video presentation. But what I wanted to do was just briefly run through it for you so that you can sort of get a bit of an idea on what I'm sort of thinking and what I'm seeing as far as the core research that comes out of these groups. Now, Zenith Partners are a specific research group. We pay them a monthly retainer to provide us with ongoing research. It's basically a part of the fees that you all pay that we get this kind of information. But like I said, I wouldn't expect to just be able to dump this stuff on you every month and expect that my clients would be plowing through 12, 14, 16 page reports from Zenith Partners. So what I wanted to do was just quickly run you through it, just so you can get an idea of what I see and where their sort of thinking is about where we're sort of headed through all this. So the first part of this report just focuses on the past returns. So what's happening over a 1 month and 12 month sort of change. And we look at various indexes here, including things like cash, including things like Australian shares, property, international shares in various regions, commodities like gold and oil, and exchange rates like the Australian dollar to the US dollar, obviously, but also against other currencies. So that just gives me sort of an immediate snapshot of where we're at, and sort of some of the highlights of sort of what we're looking at here is we can see the recovery that we've seen in the past month with these kind of green figures here, all relating to share markets. So obviously the property index, the All Ordinaries being the Australian share market up 9.53%, the international markets like America up 11%, UK up sort of only up 4%. Obviously they've been hit pretty hard by the virus. And then the movements in things like gold and oil. Obviously we're seeing at the petrol bowser how cheap our petrol is, and that's being reflected with this oil price. So that sort of is stage one sort of snapshot. And as I scroll through, it will also give me those same figures going out over a 5-year period, 5, 3 years and 1 year. So if we look at something like the Australian share market, and we take that as being the S&P or the ASX 300 up here, over a 5-year period, this last correction has really damaged those longer term returns. So much so that the Australian share market over a 5-year period is now showing only 3.51% positive, but in the last quarter, a minus 20% performance as we've been impacted by Corona. And the same can be probably seen through international markets as well. If I look at the North American market, their actual 5 years is actually 7.98%, nearly 8%. And it stresses the importance that we have our portfolio diversified, not only in Australian shares, but also in European shares, American shares, and Asian share markets, because they all perform at different rates. Probably the biggest impact in Australia that we've seen has been the listed property trust market. Now, these are trusts that are listed on the Australian share market, and they own shopping centres, commercial properties like major skyscraper type buildings. They own industrial warehouses and warehouse regions, places like Derrimut and industrial parks that work in those sort of areas. And as you can see here, this index in the last quarter fell 29%. It recovered up 13% for the quarter, but the 5-year average has been damaged just like the share market has. So look, just scrolling through the report, it then breaks those sort of numbers down to even greater degrees. Things like the performance of property trusts around the world. So we can look at these trusts that own properties in the US, in Europe, in the UK. And you can see here that all of these numbers are horribly negative in the short term. Minus 21%, minus 23, minus 23, Japan minus 24, and Australia minus 33. And the reason for that is that this virus is bringing on a recession, and in a recession, businesses are going to go broke. When those businesses go under, what happens is they stop paying rent. And as a result, these kind of trusts are going to be deeply impacted. So as I continue to scroll through, I can look at the changes in government bond yields, which is a little bit boring because not much happens there, but I sort of scroll through that anyway. I look at what people are paying for corporate debt. So if you're issuing bonds into the market as a company, what interest rates you are needing to sort of attract. So high risk debt in the US, for example, at the moment is it's costing around about 4.85%. Low risk debt is AAA debt is getting 0.04%. Can you believe that? You can borrow money around the world if you run a large company at 0.04%. And that's a big part of where we kind of see a part of this recovery is going to come from. These hugely depressed interest rates. And so much so that we've never seen a recession or a depression situation where rates have been so low. I continue to scroll down here and I can see that I can look at it at performance of different sectors. So again, looking at the Australian market, I can look at sectors like the industrial sector, the energy sector, healthcare, etc. And so what I can sort of see here is the 1 month, 1 quarter, and 1 year performance. So if I just focus here on the 1 quarter performance, because that sort of highlights the main difference. Materials is just for those of us who wonder what materials is actually resources. So that means BHP, Rio Tinto, these sort of companies. And as you can see in the last quarter, they've performed really well, positive 8%. And then if we go down to companies like energy companies, which has been affected greatly by the falling oil price, minus 15%. Areas in things that you would expect to see sort of some positives, healthcare. Obviously, companies involved in looking for a virus or looking for treatments for coronavirus, they're quite popular and they're up 15% for the quarter. Utilities, things like telecommunications, things that we've started to use more of, they've been positive for the quarter. Property, as I said, quite negative. And IT, still quite good. And what this is showing me with regards to this coronavirus correction is that it's spread across the whole economy in different ways. Each of these different sectors is being impacted in different ways. Consumer discretionary, which is, you know, the Harvey Normans, the buying the new TVs, the washing machines, those sorts of things, hardly affected. Consumer staples, which is things like food, we obviously saw that huge surge during the quarter where everybody was panic buying, and so obviously that led to some positive numbers. So this is really varied across the board. It then breaks it down and shows me how smaller companies are going compared to mid-cap companies up to large companies. And so we can see the performance in the quarter, and we can see that the larger companies, the top 50 stocks in the Australian market, have underperformed the medium and the smaller. The smaller companies are doing extremely well. And so as I continue to scroll down, I'm going to start to see some really detailed numbers now. And I'm not going to take you through all of it. I think just in a global sense, it's interesting to have a look at how companies around the world are traveling in these various sectors. And as you can see, there's a lot of minuses here where the Australian column showed quite a few pluses. So in actual fact, we're starting to see in Australia some reasonably good signs that because we've been on top of this virus and because there's been strict government controls, we haven't kind of lost the plot. And as a result, some of the rest of the world, when you look at some of their indexes, financials around the world down 23%, energy down 27%, even things like those consumer staples, which in Australia were kind of flat, they're -7%. The healthcare index is the only one that's really performing in global markets. All the rest are all negative. So it's interesting when you contrast Australia versus the rest of the world. When we scroll down here, which is where I'm going to stop this because the report does go on and on and on, and I don't want to bore you. But what this interestingly shows me is exactly how Zenith Partners are valuing various markets. And they're suggesting that Australian shares right now are cheap. They're saying that the small caps, and which have obviously done quite well of late, have become to moderately cheap. Global shares quite cheap again, and emerging markets cheap, and Australian property trust, the real estate investment trust, which is REITs, they're cheap as well. So when you look at where we are in the Australian market, we still see some buying opportunities, and so does Zenith Partners. They feel that the time is kind of right to be looking at selectively buying stocks in sectors that are going to perform. As I said, I'm probably only halfway through that report because it does go now into a fair bit of in-depth comparisons versus indexes, a lot of things that I really could show you, but at the end of the day, I really don't think it's going to be terribly compelling viewing. So look, I think it's interesting that if you want to have a look at this report, you can read it in the same way that I've sort of taken you through here. As I said, I don't expect my clients to be doing too much in-depth analysis, but it helps you to understand the sorts of information that we're getting and how we're kind of digesting that information and putting that through the portfolios that we're managing on your behalf. So thanks for listening. I do hope I didn't lose you after the first sort of 4 or 5 minutes of this presentation, but it's interesting to see just how the wheels actually work and how the information that we're getting is being absorbed and then sort of forced out to you. So again, stay safe. Look forward to seeing you not too distant future. We're getting a lot of restrictions lifted during the months of June and July, so we should go back to normal meetings after that. Cheerio. Have a great week. Thanks for listening. Bye.